This show is strictly for educational purposes. The opinions expressed on the show are personal to the individuals appearing in the show and not those of Thinking Tree Ecoholics Private Limited. The show is not intended to offend or defame any individual, entity, caste, community, race, or religion, or to denigrate any institution, person, living or dead. Listener discretion is strongly advised.
Hello and welcome to Ecoholics Thinking Tree series. Today we have with us very renowned personality S.S. Mundra sir, to discuss about the contemporary role of RBI in Indian economy. He was a deputy governor in Reserve Bank of India, India's central bank, from 2014 to 2017. Previous to that, he was chairman and managing director of Bank of Baroda, a commercial bank in the public sector banking in India. Welcome sir, welcome to our show.
Thanks, Sanat. It's my pleasure.
A country's prosperity is much affected by the decisions taken by its central bank. More so in case of India, where Reserve Bank of India also functions like a developmental institution and is the lender of the last resort. To begin with, sir, given the current situation is extraordinary in character, how do you see the response of Reserve Bank of India in general to this crisis? Has it been sufficient so far?
Well, it's a very all-comprehensive question, Sanat. But yes, first I must say, probably Reserve Bank of India is one of the few central banks in the world which can be called as a full-range central bank.
Yes.
So it's not only the monetary authority, it is the currency authority, the reserve management, is the debt manager for the government, and then developmental things. So there is a host of activity. Coming to your question, I must say that Reserve Bank of India has taken quite a few steps. As we all know, the pandemic is a unique kind of crisis. And, we generally talk about black swan events, but this was something even, blackest of the black swan. No one would have thought, and we still don't know at what point of curve we are. So
Yes.
why I am mentioning this, it is very important that there has to be a calibrated pace of the measures which are being taken. Because if you know the dimension of the problem end point and you use all your arsenal, but when you don't know the end point, you can't really work out that ultimately where it is leading to, what could be the dimension or proportion. So that way, calibrated. If we just recollect, RBI first came somewhere around end March, 27th March, when they announced certain measures about the moratorium, some relaxation in working capital, followed it again in April, then again in May, extending the moratorium. So quite a proactive step which RBI has been taking. What is more important, during all this period, the RBI's communication with the market participants had also fairly intense.
Yes.
And in today's time, communication is as much a monetary policy tool as anything else. So, in addition to that, I think they have used many conventional, but more importantly, non-conventional measures. Now, repo rate, we all know, is a conventional thing, and that is always done. But in addition to repo rate, I think RBI has done many things to infuse the liquidity in the system. They have opened the liquidity window for mutual funds, more recently for the NBFCs. But apart from that, some new instruments like, LTR, long-term repo option, and TLTR, targeted long-term repo option. First time, a symmetric change in the repo and reverse repo rate, where both have not moved in the similar proportion, right? So then operation twist, where you are trying to condition the expectations in the bond market. So these are quite a few things which they have done. As a result, liquidity is ample in the system. Having said that, I think that is one area where I felt that RBI somehow, if I use the word, drags its feet. That was about this whole NBFC issue, whether the moratorium should be extended or not. Yes. And that, that confusion on that, not giving clear signal, created some damage in the market, which is already, everyone knows. Anyway, this is behind us. Since then, things have been repaired to some extent. But probably a quick action on that front could have resulted into something different. The other area where I have not heard anything, but I think would warrant the attention from central bank is about the forex exposure of Indian entities. In the recent past, Indian entities have taken substantial forex exposure, and given the condition, whatever is happening, it will have its own negative fallout. So I think that is another area where the RBI would have to pay attention. But these are, immediate things. But going forward, as I said, number one, depending on the duration and the intensity of whatever it is leading to in the economy, ultimately, probably RBI will have to consider giving a one-time restructuring options for the bank's borrowers. That is something which would needed to be done. That apart, they may have to expand the collaterals which are acceptable to them. So
Yes.
maybe the good quality AAA corporate bonds would have to be included in the collaterals. They
Yes.
have so far they have done their lending operations limited to banking system. But I think a time may demand where they may have to consider other players in the financial market to be included, like the insurance companies or NBFCs, who can
Yes.
directly access the RBI's liquidity window. So, and again, as I said, depending on how we move, but then there is a whole host of things which may need a relook, because this is very extraordinary event which includes the accounting norms, even the capital requirement, even the provisioning requirement, and finally, if at all needed, one may have to even consider the monetization of deficit. So the short point I am trying to mention is nothing can be ruled out. All the options should be available on the table, but yes, they would need to be deployed depending on the need.
Depending on it. Yes, indeed. Because, sir, RBI has been reducing the interest rate, but there is a less demand of the loan or credit, fresh credit. So, how do you see the situation? Are we moving towards some low interest rate, or what we can say liquidity trap in economics?
See, this issue on both sides. The issue of credit is on both sides, on the demand side as well as on the supply side. Now, demand side, number one, the seeker of credits, they themselves are not sure that again at what point they are, what kind of damage their business has already suffered, whether they would like to incur additional liability without knowing that what kind of cash flow they can expect. So that is one sort of part of it. But on the other part, even the people who are prepared to seek the credit, but the supply side problem is there, because see, now problem is not liquidity. As we have seen, RBI has done a lot, and the system is really overflowing with the liquidity. There is a liquidity overhang. But the whole issue is around the credit quality and the risk perception. And again, yeah, same thing is true for a lender also. If they don't have a clear visibility of the borrower's cash flow, borrower's business position, how long they are going to remain in shut or reduced operating mode. So obviously, bank would also be cautious. So I think this is a point where we are currently stuck. Though government has also pitched in. They have given the credit line support to MSME. That measure has been announced, but all this would not be suffice. So essential point would be number one, the clear visibility of the road forward, but also very important for the lending community at this point of time would have to have a backup support from the authorities, maybe the central bank or from the government. That would be the way forward. Otherwise, liquidity would remain there, but it may not reach to the intended target.
Seriously. Yes. The negative interest rate policy, once considered only for economies with chronically low inflation, such as European countries and Japan, now is becoming more attractive option for some other central banks to counter unwelcome rises in their currencies. Do you think that is where RBI is headed? And is there any major benefit that India can reap from this?
Again, I think, as you see, number one, the negative interest policy typically is for the country with the very low inflation rate, right? And the problem is to stimulate the demand.
Yes.
Okay, we are nowhere near that situation. Inflation rate is low, but is not in the periphery of being the negative. That is one thing. The second important point is ultimately, what a negative interest rate policy is generally, what indication it is giving. It is encouraging the people, the consumer, to spend and not save.
Yes.
So if you don't save, you don't invest.
Seriously.
Now, this could be a good situation for a country where there is a social security net is available. The country where there is no social security net, and there for the people to stop saving and start consuming would be a very difficult call. Even for a larger and long-term perspective, for the economy also, it would not be good, because I think we need saving, we need investment. So, as far as India is concerned, I don't see that we are anywhere near the experimenting with any negative interest rate.
Indeed. Since you have the complete experience of working both for RBI and a commercial bank, how do you see the effectiveness of RBI's monetary policy transmission?
I think it is the most often debated issue. See, number one, there are two things. If you look at the monetary policy action of the Reserve Bank of India, and you will be clearly finding that the transmission is quite effective and almost near total as far as the market is concerned. Yes. But when it comes to the lending side of it, is a very different thing. Yes. So that is quite clear. But the effectiveness of this cut and transmission would really be tested when it gets translated into the bank's balance sheet and the bank's lending, because Indian system is still a bank-led system. Unlike many Western economy, where the system is market-led, where the financing is also catered by the market, and their transmission quickly happens, and you can call it effective. In India, if the transmission is happening in the market, it is only benefiting some of the debt player and the fixed income traders. Yes. Money is moving within the system, banking system only, is not reaching to the lender. That is the problem. Having said that, there are certain rigidity in the system. There used to be, of course, one major barrier about the various government saving schemes, which still offers a certain, and which kinds of creates a floor. Of course, saving rate is deregulated now. Otherwise, it also used to be a barrier. So those rigidity in the systems have come down gradually. But issue is little larger and complex. As I said, it's a bank-led system. Yes. And bank's liability is mostly comprising of the depositors' money. Yes. Unlike the large banks in modern economy, where the resources are again coming from the market, our resources are coming mainly from the depositors. Yes. And again, these deposits are of fixed tenure and fixed rate of interest. So there is always that one rigidity is there, that immediate transmission becomes difficult. Second issue is around the the asset quality problem which banks have been facing in the recent past. So there is a huge stock NPA which has been going on for some time. It means a substantial part of your asset is not earning interest, whereas you have to pay interest on your entire liability with the deposit. So there is a pressure on margin. See, I am not telling that these are all right regions. If there is a rate cut, but the ground reality, as a practicing banker, ultimately a bank has to protect the margin. If transmission, if I say just for the instance, if transmission happens completely and it translates into bank is hardly having any spread or any margin, then what will happen? The bank will run into the losses. And since the banking system is still primarily public sector, it means they would need the capital. It means again the majority owner has to provide the capital. So one way or other, ultimately the burden goes on the public actor. So we have those problems. On top of that, in our system, again, you have a priority sector lending obligation. You used to have a substantial SLR obligation. You have the CRR obligation. You have many schemes where the interest rates are still kind of structured. So with all this, a small chunk is left where the banks can make up for what they are unable to earn elsewhere. And that is where, if that small portion is also completely exposed to this kind of transmission, it ultimately becomes a problem of the margin. So these are the complex issues. I'm not justifying any of this, but what I am trying to say, this is a reality of life in the business, and these are the rigidity. You must have seen as some of these rigidities are removed, like as I said, what you call it, the administered interest rates have been reduced, or the SLR requirement has been gradually brought down. To that extent, transmission efficiency has been improving. So the key point would be both. As number one, as banks come out of their problems of this asset quality and all that, their asset start earning to the full extent. Some of this rigidity in the systems are improved. Transmission will actually improve accordingly.
Yes, indeed.
Unfortunately, there is a section of banks which are not facing all this problem to the large extent. And if you look at the margin or spread which they are earning, it is unusually high, 4% plus, which you will nowhere find in the banking system anywhere. But they also don't completely, pass on the transmission because, marketplace, if this opportunity is available, why you are there to sacrifice? So there's another dimension.
Making most of it, yes, sir. Because indeed, sir, RBI has tried a lot of things. Currently, MCLR is also not very effective, so they are trying to modify that before that base rate.
It's a long journey. You say BPLR to base rate to MCLR to market link. All these things are good, but the very fact that every couple of years you are required to tweak with this policy rate itself is suggesting that problem solely is not in the construct of the rate. Problem lies elsewhere. And this is what I was, detailing that there are rigidity in the system.
So it means that by and large, government has to recapitalize because the problem of NPA resurface again and again in the future if we do not remove these rigidities.
Yes, because banks should be able to earn the profit, and then there would be a greater ability for the transmission and for everything else.
Since you have mentioned about non-performing asset, if we talk about NPA problem in India, as per data quoted in the latest economic survey that I was reading, the public sector banks account for around 92% of the cases of fraud. A large majority, 92% of those, suggesting poor quality of screening and monitoring process for corporate lending adopted by public sector banks. What are your thoughts on it?
It's a complex issue. And number one, I think, let us be clear. You started with the NPA problem and you have moved to fraud. Now 92.9% of the fraud. So now number one thing, every NPA account is not a fraud, and every fraud case is not a credit related case. So first let us be clear what we are talking about. We are talking about NPA, we are talking about fraud. These are two different things.
Yes.
Moreover, I don't know, 92.9% is amount or number of cases?
So this is number of cases.
Okay. So, number of cases, there will be smaller amount cases which will be typically with the public sector banks, so number will be larger. But anyway, without going into these data points or some of the inconsistency, complex issue in the sense I said, we have to little bit go into the history. See, post 2008, post GFC, global financial crisis, there was, again, certain measures were taken. There was ample liquidity. It coincided with the same time that the infrastructure was taken as a big area for the boosting the economic growth. And that the PPP model was introduced, public-private partnership. Before that, DFI as an animal had vanished from the scene. There were no, development financial institutions. System was flush with liquidity, and for the banking community, it looked like a very attractive opportunity to deploy the large funds in these kind of products. Agree, they didn't have much of experience of doing, the project financing. And many of these things were driven from the always the controlling office of the bank, because it is easier to do that. So, and on the other hand, most of these projects were handled by a handful of the promoter groups. You can count them on fingers. So things started with a right note. I won't say that the seed of this being bad or being fraudulent were sown at that stage. But as the time progressed, two, three things happened. Number one, many policy issues came up, which resulted into delay in the projects, cash flow projections going haywire. Second, as more and more opportunities were coming, and as there were a handful of promoters, obviously the equity available was also limited. And I think at some point of time during this journey, many of these promoters started becoming creative. Creative in the sense they started thinking how you create or produce or present an equity which is non-existent, which is not there. And that is, the fallout which we have seen. These things where, of course, the share of public sector bank in the overall lending is higher, so their percentage in this was also higher. Moreover, as I said, that probably yes, there we can say that they probably became more enthusiastic about it without really understanding this area of lending completely. Other thing which happened, if you look at is not that it was public sector banks only. There were few private sector banks also. Few decided to stay away from this financing completely, but few were very much into this, as there were other public sector banks, and they also suffered in the same extent. But there is only one difference. These private sector banks had the greater ability to mobilize the capital and clean their book quickly. So when they faced this problem, they kept on cleaning it and using the capital. Public sector banks had both the constraint. They didn't have the capital. When they didn't have the capital, they didn't have the ability to clean the book. So the incentive for them was more to postpone the problem, because you don't have ability to deal with the problem now.
Now, yes.
And there also another thing played the role, because typically the tenure of a public sector CEO is short.
Yes.
So there is another incentive that you postpone the problem by the time terms gets over, and then is a problem of someone else.
Yes.
A private sector bank CEO won't have the same incentive, because the problem today they have to face tomorrow also, and they have to face day after tomorrow also. So I think it was a combination of all these things which created what we have seen.
So what do you think, sir, like recent merger from 27 to 12 public sector banks, that will help in taking big decisions, bold decisions from the public?
See, merely by merging, of course, it gives you greater capital, which gives you a greater ability, which enhances your ability in terms of single party exposure and the group exposure. All those things are fine. But this does not necessarily result into taking a bold decision, because decision is a decision as a bank you take. So I think number one, mergers, if they are done for right reason, to my mind, a merger should achieve one of the two, three purpose. Either it should give you a better geographical reach, or it should give you a better product range where your individual, synergy is complementary to each other, or it should give you a more efficient manpower. So if merger is done with all those intent, then it can be beneficial. But the point always, which I have seen several times in my career, policies are always good, blueprints are always good. The problem lies in the execution. When it comes to the ground level execution, and if execution is not done efficiently, then sometimes you end up having the negative outcome rather than the positive outcome. And just last point on this, Mind it, when you do any merger or amalgamation, everything else is easy. Amalgamating balance sheet is not a problem. Technology platforms can be made compatible with little bit of efforts. All other things can be done. The biggest problem, not I won't say problem, the challenge is the merger of organizational culture and human resources.
Human
Because
resources.
because human resources, a human being is not a technology platform. It is not a piece of furniture. So it is run by the emotions. There are deep rooted loyalties. There are deep rooted suspicion.
True.
So it becomes a very long term process. So one has to be careful about taking care of all those. Then it can become successful. Otherwise, you end up spending a lot of energy without reaping the benefits.
Yes, very true, sir. Very valid point. Talking about non-banking finance companies, in the last couple of years, we saw the defaulting of two major NBFC, INFS and DHFL. The major reason behind this was the rollover risk associated with using short-term credit for lending long-term loans. The constant refinancing and asset liability mismatch aggravate the problem. What, according to you, are the alternatives that can be used by NBFC to decrease the risk of defaulting?
Uh, good question. Again, two things. You quoted two names. I won't go into the specific any individual entity, but for the sake of a good discussion and understanding, first let us understand that both are NBFCs, but
Yes,
both by the business model and the line of activities are very different kind of
very
things. So their problems would not have come for the similar reasons. Uh, the NBFCs, which are typically in the infra financing, initially their problems have become more. One, of course, the mismatch between the liability and the assets duration, but also that apart from lending, they also chose a model to become co-owner of some of the projects. Apart from being the lenders, and then the whole wave of subsidiaries companies through which they are trying to execute the project also. And here all one, like any other infra company, they also suffered from the lot of policy issue, delay, the environment clearance and all that. So that is one thing. Second, in trying to the fix their borrowing or their lending to the liability profile, it was insisted to try to fit the loan in a shorter duration than what should have been the logical for this kind of project. And
true.
borrower also, because at this point of time they are in need to agree to everything. So cash flow, IRR, DSCR, D ratio, everything is designed in such a fashion that it fits the requirement of the lender, but it doesn't translate into reality. So that was one kind of problem. Elsewhere, yes, short-term liability, long-term assets created problem. Of course, there had been some sharp practices which all we know. So it was a combination of all that. The issue is what could be done about it. Now, there are two three things I would say. One, ideally, these are the kind of activities where they, long-term financing which they enter into, should be typically catered by the market. And that has been another, I think, most debated and long outstanding item in the Indian system, Indian financial system, that is the development of an efficient bond market,
Yes.
which is not there. That would be the solution. These people need the long-term resources, but there is no long-term resources which are available for this kind of activity. So the requirement would be, when this is the given situation, these institutions should be able to follow the model what is called as the originate and distribute. They should not be expected to originate a loan and then remain married to it till the final maturity. And this is how any efficient market functions. Because at the time of origination, there is an execution risk. So certain institutions which are specialized in taking execution risk, they do the financing, they charge a little premium for that. Once the project has matured, then it is offloaded to the market for the long-term player. and they earn the spread on it. So, in the shape of IDF and all that, some efforts have been made in that direction. But despite these institutions having come into existence now more than 6-7 years, they have yet to get any traction. So ultimate solution would be that number one, there should be a good bond market. Number two, there should be a good supply of long-term resources for this institution. Number three, they should be able to originate and distribute. And number four, there should be takers available who can take these loans once they are out of the project execution. That should be the way forward.
Absolutely, yes. In the recent past, there have been lots of debates regarding the excess reserve transfer from Reserve Bank of India to the Government of India. On one hand, we have had economists arguing for years that the surplus money can be put to better use rather than sitting with RBI, while on the other hand, the transfer of that surplus to the government's account has been criticized, saying the move will have implication for RBI's balance sheet, union budget, finance markets, and debt management by the RBI. What is your point of view, sir?
Okay. I'll keep it very short because this issue was debated for a very long time. Yes. But in some sense, now it has become a non-issue because whatever was to be done in this area has already been done. But yes, having said that, 2-3 points I would say. Number one, let us understand that Reserve Bank of India is a fully owned subsidiary or institution of Government of India. So whatever is with Reserve Bank is with Government of India in one sense or other. So yes, whatever else you do is a more accounting, entry rather than any real change in the ground situation. Second, there is a merit, particularly in a developing emerging economy like us, where the finance of the government are not always, in the best of the shape. It's important to have an institution which can be AAA on its own without any sovereign rating support, or I would say which should be able to pierce the sovereign rating.
Yes.
And that is the benefit of this institution. To in time of need, it can deal with the you are a capitalist of country. You will continue to need the capital support from the international market, and for doing that, if there is an institution which on its own has a rating which is the best rating, which is acceptable, will have its own benefit. I'll just say two things. Two live example now, which proves that why RBI should have a good amount of reserve. One, because of the strong balance sheet of RBI, it had been possible to negotiate and establish the swap line with many other central banks in the international area. You need a good credit rating for that. They will not give you out of love for you or just because they like. And in today's crisis, again, see, because government finances are not in great shape, as we know, even before the COVID. But because RBI has a strong balance sheet, there are quite a few things which they are in a position to do. And if need be, they would be able to do. As I indicated in reply to my earlier question, maybe a stage may come for the monetization of deficit or any such thing. Again, the strong balance sheet of RBI would come to play. To conclude, despite all the initial, heat and fire and debate, and finally the committee was formed, and committee had two eminent, ex-governor Dr. Jalan as well as ex-deputy governor Dr. Rakesh Mohan.
Yes.
All has been done, and finally, I think they have also reached to a conclusion that RBI need to have a certain level of reserve. Whatever is surplus more than that, that can be transferred. So, a sum of 1.76 lakh crore was transferred out of that committee. Yes. But again, it would be wrong to believe that it was completely a transfer from the reserve. Major part of this was the annual dividend which RBI in any case gives to Reserve Bank of India.
Yes.
Actually, it was during Dr. Rajan's time that similar exercise was done, and a decision or a view was reached that RBI has already reached to a level of certain reserve which they want. So now going forward, whatever profit RBI earns will be completely fully transferred to Reserve Bank of India, to Government of India. And that was done. Since then, it is being done like that only.
Okay.
The point was, if ground reality changes and reserves are to be further augmented, only then this policy would be changed. So, out of this 1.76 lakh crore, if my memory serves me right, there was only around 50 or 52,000 crore which was considered as a surplus reserve, which was transferred. Rest was the dividend transfer. So I think this is a well settled issue now. Till such time anything new happens, no further debate I think is likely to happen in this area.
Yes, it's a regular phenomenon. Thanks for the clarity, sir, and thank you for coming to our show, because I personally am a very big fan of you, because you have started your career from a probationary officer to the top of CMD and then deputy governor. So thank you. It's my pleasure to have you on Ecoholics Thinking Tree.
It was my pleasure also. These were the good questions, and I must say before I conclude, I was honestly I was not familiar with Ecoholics, but once you approached and I saw the profile, I saw the journey of Ecoholics and how it started doing some very good work in the area of economic, tutorial to the students as well as to the people who are aspiring for the professional courses. So starting from that journey and now then having a not for profit this kind of a platform which could be very useful both for the students as well as for the other people who are interested in the policy environment in the country. So it's a good initiative. I compliment you and your team, and I wish you all the best. Keep on fine tuning it, keep on making it more and more beneficial for all your audience.